Our revision session today, we will look at some theoretical questions that are in units 1 to 3 before we look at the calculations of the ledgers. So I implore you to participate. So question number 1, the International Accounting Standards, IASB, has developed a conceptual framework for financial reporting. Briefly describe the principal features of the conceptual framework. So what are the key principal features of the conceptual framework that we know of? So we know the International Accounting Standards Board conceptual framework will provide us with the conceptual foundation for preparing financial statements. And some of the key features include number one, the objective of financial reporting, which is to provide what? Information useful for decision making by who? The lenders, by the decision makers, who are the managers. The principal features of the ISB conceptual framework would also include what? The qualitative characteristics. Remember the qualitative characteristics? They also include the elements of financial statements and also the recognition criteria. They also include the measurement bases and concepts. So the objective of financial accounting information, which is useful to these key stakeholders. What else? What else are the principal features of the ISB conceptual framework? The features may include the qualitative features. We know the qualitative are into two. What are the two qualitative features? So in the objective, firstly, I said the objective of financial reporting is to provide what? Useful information about an entity, information which will help decision makers about um, buying and selling or holding equity. It also has the qualitative characteristics that are useful, and these ones will determine the usefulness of this information. So we have the fundamental characteristics as well as the enhancing characteristics. The fundamental, we use the acronyms RF. They include relevance and faithful representation. This must um, include information being capable of influencing decisions, predictive decision, confirmatory value. Then also the faithful representation, we said information must be complete and neutral. The enhancing characteristics, we said we use the acronyms CAT-V. C is comparability, U is understandability, T is timeliness, and V is verifiability. So comparability, you must be able to what? Enable users to identify similarities across different entities. U, understandability, meaning information should be presented in a clear and concise manner. T, information should be what? Available on time to influence decisions, and verifiability, meaning different knowledgeable observers can reach similar conclusions. Then also elements, these are part of the ISB. So this is just a summary of your first 3 chapters. So the elements in the financial statements may include assets, liabilities, equity, income, and expenses. What are these? When talking about assets, we're looking at what? Resources controlled by the entity as a result of the past events. Those are assets. Liabilities, these are present obligations arising from past events. Equity, what is equity? This is the residue interest in the assets after deducting the liabilities. So it's what we put in as owners. Income, these are what? Any increases in economic benefits that may come into revenue or gains. And expenses, what are expenses? these are any decrease in economic benefits like costs or losses. So from these elements, we form basis for preparing statements like the income statement, which is the trading profit and loss account, and the statement of the financial position. The ISB also gives us the recognition criteria. In terms of recognition, it's a process of including items in the financial statements. So an element can only be recognized, number one, if it meets what? The definition of an element. Is it an asset? Is it a liability? Okay, an element is recognized when it is probable that the future economic benefits will flow to or from that entity. An element is recognized when it can be measured reliably. So the AISB also gives us measurement bases. What are these measurement bases? The framework will provide several bases. We have what we call historical cost, where assets should be recorded at their original price. We also have fair value, where we're going to look at the market price based value. We also have the current cost, which is a cost that can replace the asset today, and also a fulfillment value. Then ISB also has concepts of capital and capital maintenance. So those are the guiding system. Then that is carrying about how many marks? Just about 10 marks. Then describe measures that have been instituted by the accounting profession to ensure that the accounting information is truthful and valid. What are some of the measures that have been instituted by the accounting profession to ensure that information is what? Um, Truthful and valid. Anyone who wants to try on that? So I don't want you to underrate the theoretical part of your exams. As we discuss, we get to understand more. So we're just going to discuss what we know. This is just from the quizzes or units. This is unit 2. Okay, who wants to try? We're looking at unit 2. By the way, your exam is what? 70% theory and sometimes 60% theory. It varies.
Actually, I was on the road, so it's gonna start. What was the question again?
We're looking at question number 2, part B. Explain the measures instituted by the accounting profession to ensure that accounting information is truthful and valid. So such are some of the questions that come and you get confused. You're looking at uh, far off concepts when these are questions that you should look at. What are some of the measures to ensure that information is valid in accounting? This is what happens in our companies. Auditing, all right, is number one. How the independent auditors will come in, both internal and external, may come in to examine the financial statements for accuracy. Number two, how does the accounting profession ensure that information that we have is valid and truthful? Using what? Accounting standards. Using accounting standards. That's why we have these accounting standards. So accounting standards are put in place to ensure that there's uniform what guideline. Okay, wherever you go. They are also what we call professional ethics that are put in place. So all these are in your notes, but they are being brought in a different way. Okay? We also have internal controls where you put systems in place to prevent errors and fraud. And also what? Regulatory foresight. So these are some of the ways that accountants have um, used to ensure that information is what? Is truthful and valid. You can add your own if you want, okay? But these are some of the ways in which accountants ensure that information is what? Truthful and valid. Through auditing. Auditing is one way to safeguard what information. It involves you having independent auditors. We have auditors, can be external. They'll assess the financial statements whether it represents a true and fair entity, and they verify the documents, they test the transactions. The auditors also give an audit opinion. The accounting standards, IFRS, we've just been talking about, these are standardized accounting rules that will ensure there's what? Consistency and comparability. So we have what we call the International Financial Reporting Standards that were developed. This is for the private. How about for the public? Which standards do we use? So these standards will provide a clear guideline on how to recognize, how to measure, how to disclose information, and they limit our use of personal judgment. Then also professional ethics. So ethical conduct of the fundamental uh, these ethical conducts, they are important to ensuring that there's valid accounting information. So accountants are required to follow ethical principles. What principles are there in ethics? Integrity, being honest, objective, avoiding bias, professional competence, and due care. So you maintain knowledge and skill. Confidentiality, you protect sensitive information because you're dealing with different companies. And professional what? Behavior, we comply with the laws. In internal controls, we will look at what? Systems that are put in place and policies within an organization to ensure that there's accuracy and prevent fraud. What systems can you look at? Segregation of duties where you have different people handling certain information, authorization and approval procedures, regular reconciliations and reviews, and also fiscal controls. And last but not the least, regulatory oversight, where government agencies and regulatory bodies will play a key role in enforcing compliance. So authorities will monitor whether companies are following these standards. They'll send people from what? ZRA and other to inspect and impose penalties. So in summary, what are we saying? These measures, which include auditing, standards, ethics, and internal controls and regulation, they create a comprehensive system of checks and balances that will ensure that the information that we have is what? Is accurate, reliable, it's transparent, and it is useful for decision making. All right. Are we following? Are we together? I don't want to
Yes,
underrate
sir,
this
yeah.
part.
Yes,
I've
we
seen
are.
people
For
using max because of underrating such important. So, what is the usefulness of the conceptual framework? Anyone? What is the usefulness of the conceptual framework?
Maybe it helps to guide on how uh, these financials or maybe businesses control.
Yes, it guides accountants on how these financial statements and controls should be done. Anyone else? The use of financial, the conceptual framework? Mm-hmm. Yes, these are all there in my pamphlet. I think, I hope you've been reading.
Mm. So that means to promote comparability, to be able to compare the the performance of the organizations, of the businesses
Yes,
across the industry.
to compare across industries. That's true. So the conceptual framework
Mhm.
plays a crucial role in improving what quality and usefulness of these financial reporting. So its importance can be looked at through those key points. It guides accountants on how to prepare financial statements. So it's through the conceptual framework where we have clear principles that accountants follow. They don't just prepare anyhow. It will help them applying consistent accounting policies. For instance, I give an example of an adapter, a plug. I can use it in Kenya, in Uganda, in the United States. Same with accounting. It has to be consistent wherever you go. So it ensures that there is financial information which reflects what economic activity. Secondly, to promote consistency and comparability. So one major advantage is this of uniformity. So you have companies that have subsidiaries in different countries. So by doing so, they follow these same principles. And this is what is used to compare these ratios in a similar manner. It's easy to follow performance, seeing how these organizations are performing in different areas. So investors would want this, especially for economic decision making. And also it assists in what development of accounting standard. It is using this conceptual framework. Remember, the first one was developed in what? 98 and revised in 201. Okay, so it is this which assists to develop these accounting standards, the conceptual framework. Okay, so it serves as a foundation for developing new accounting standards like the IFRS, the International Financial Reporting Standards. So it is standard setter. It is used to ensure that these standards are logical and consistent, avoiding contradictions between different standards and providing a structured approach to addressing emerging accounting issues. So it will promote a systematic way of doing things. And the conceptual framework also helps resolve what? Accounting issues not covered by the standards. In practice, not all accounting situations are addressed by these standards that we may have, I must confess. But this conceptual framework at least to give guidance in how to deal with the new or unusual transactions. So accountants will basically rely on these principles to make sound and professional judgments. So reducing the aspect of inconsistency and uncertainty. And it also helps to enhance what? The user's understanding of financial reports. So the conceptual framework will improve how users will interpret these statements to explain the underlying concepts and assumptions. It will also help users gain better understanding on how figures are measured and represented and increases confidence and trust in financial information. So in summary, what is the use? For guidance, for consistency, for development of standards, to resolve unregulated issues, and also understanding of um, these decisions. All right? Are we together? Any questions so far?
We're together, no questions.
Okay, so if it's clear, let's go to the next. What do you consider to be the difficulties resulting from the development and use of conceptual framework? What are some of the difficulties resulting from the development and use of the conceptual framework?
I think one of them should be training and expertise.
On the what?
The difficulties on, I think one of them should be on training.
Yes, training, yes. Has limited knowledge. It's complexity.
Mhm.
Very true. What else? The challenges with the conceptual framework. I've given you some points
Maybe
to
it's
guide you. Mm-hmm.
maybe one of, okay, I brought something, but I was thinking maybe one of them is also there's a cost attached to it.
The what?
Or maybe there's a publicity which happens as a result of that.
The,
Your competitors might be getting some of the information from you, or competitors would be able to look at what you're planning.
okay. Yeah, somehow. So, while we understand that this accounting standards board conceptual framework is useful, we should also underscore that there are challenges that happen in practice. And these limitations actually affect the application and effectiveness of financial reporting. So, number one, you spoke about what? The aspect of training or limited knowledge. So the complexity for some users. So the conceptual framework can be difficult to understand for non-accountants or non-experts. So it contains some of the technical jargon and terminologies which small investors or public will struggle to interpret. So this will reduce accessibility. The aspect of the abstract nature makes it difficult to apply. So the conceptual framework sometimes largely principle based. So that's why we learn principles of accounts. If you have no principle or no theoretical knowledge behind, you may not understand. So it provides general guidelines instead of detailed instructions. So for you, you need to learn like you are learning right now. So accountants sometimes find it difficult to apply just some abstract concepts in the real world, accrual, okay, duality concept. So different interpretations can come because of lack of specific direction. So also it requires professional judgment. It relies on the use of professional judgment. So accountants must interpret these concepts like the relevance, faithful representation. So different professions arrive at different conclusions when they're faced with a similar situation. So it may reduce what? Consistency. Then the non-legality is not legally binding. So the conceptual framework in itself is not a law or an authority. So it is just an accounting standard. It may not override specific principles like the International Financial Reporting Standards. So in case of conflict, accounting standards can take precedence. So this limits the ability to enforce uniform practices because it is not legal, it's not law. Also, conflicts may arise in difference of understanding of concepts. So sometimes different concepts within the framework may conflict each other. For instance, relevance. You know what that principle says. It may require timely information, whilst faithful representation may require that you give what verification and what accuracy. So choosing one of the two will conflict because you're looking at time and also you're looking at relevance at the same time. All right, so let's look at the aspect of identify and discuss the four advantages of historical cost accounting. What are some of the four advantages of historical cost accounting? Do we understand what historical cost accounting is and what are some of the advantages?
Historical cost accounting.
Yes. Anyone? When you bought land at 50 kwacha, even today you should value it at 50 kwacha. That kind of historical cost accounting. Uh, what are the advantages of going by that? Why should I value my house at the amount I bought it for at the historical cost? I'll give you highlights which you can expand according to your understanding in it being an advantage. Okay, so historical cost accounting is basically a traditional method of measuring assets and liabilities based on their original purchase price. So despite the emergence of other bases that we've had, so it is widely used due to several advantages. And some of the advantages are that it's objective. So historical cost has the aspect of what? Objectivity. So values are recorded at their original price, not estimates. So this reduces on influence of having overstatements where people create some biasness in stating what the true value of their things are. So it reduces, it ensures that the financial information is verifiable. Number two, the advantage it has is reliability. So information prepared using historical cost has verified what? Source documents. I bought this for this amount. Okay, declare how much your assets are. Okay, how much is this worth? All right. So you are giving yourself what? That kind of reliability. Then also simplicity. Simplicity. So using historical cost is very simple. You don't require complex calculations. All right. Accountants can easily record and maintain what? The financial data which is there, both for large and big organizations. And consistency. Historical data promotes consistency. So assets are recorded using the same basis over time. It allows for comparison across periods. You're using the same value. You're not inflating it or underrating it. So these are the advantages that you have. All right. So now,
Um, sorry,
let's,
please just go through the definition once again.
so what is the definition of historical cost? I said historical cost is simply a traditional way of measuring assets and liabilities based on their original what? Value. If you bought land at 300,000 and now it's 800,000, we're going to use the same original despite the appreciation. That is historical cost. Are we together?
Yes, thanks.
All right. So I'm trying to be as basic for beginners. So I'm explaining past paper, but in using a basic approach. So now explain the qualitative characteristics of financial statements as provided by the conceptual framework. What are the qualitative characteristics? I spoke about them. What are they? Qualitative characteristics. Uh-huh.
We're supposed to talk about the relevancy and the
Good.
effectiveness.
Uh-huh.
Okay.
This the general categories. They're into two.
Okay.
Uh-huh.
Relevance and the
No, fundamental and
effectiveness. Fundamental and complete that those which
enhancing
amplify.
characteristics.
Enhancing. Okay, enhancing.
Under
Yes.
fundamental, we have two. We use acronyms
Relevance
RF. And
or
under
relevance and faith.
uh-huh. And under faithful representation, we have what?
We've
Five.
got 4, which is
Uh-huh.
5, comparability,
Cut fee. Uh-huh.
timeliness,
Uh-huh.
and then the understanding and
Uh-huh.
verifiability.
Yes. Okay, so these are the characteristics that are there, the qualitative characteristics. Yes. So what uh, um, is implied by each of these ones? So these ones are all the questions that we may ever have under what? This unit. All right?
Mm, mm.
These are so the qualitative characteristics, they actually define what makes information useful to users like you and me, investors, lenders, and stakeholders. So according to the International Accounting Standards Board, they are divided into two, fundamental and enhancing. The fundamental are the most important qualities that financial information must possess. Like relevance, information must what? Be relevant if it can influence economic decisions. So it must be predictive in nature. It must help to forecast the outcomes. It must be confirmatory, meaning it must confirm or correct past transactions. For instance, if profit figures help investors decide whether to invest or not, it will be useful. Faithful representation, information must accurately reflect the economic reality of transaction. So it should be complete, meaning it must include all relevant information, must be neutral, free from bias, must be free from error. There will be no material mistakes. So recording of all liabilities must ensure that financial statements are not misleading. The enhancing characteristics, these improve the usefulness of the information that is already relevant and faithfully presented. So we have comparability, which allows us to compare financial information between companies and countries. Verifiability means to ensure that information and that knowledgeable people, if they were to come independently, they'll all get what? Similar conclusions. So information, it can be checked, but same answer. Timeliness, information must be there when needed, not it comes years later. So delayed information is irrelevant information. So real-time information is useful. Understandability information should be what? Presented in a clear and concise manner. So you should avoid unnecessary complexity, jargon. Users must be able to what? Resonate with the information, interpret it. So these are the key information that we are looking at. All right. So are we together? And finally, but not the least, we're asked to explain what? The following terms with an appropriate example. What are accruals? What is consistency? What is going concern? Uh-huh. Anyone? So I should assume you know that. Should be as your homework, right?
No, 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 no. No, no,
Uh,
no, sir. Let's go through them. I don't know. Cynthia, what do you say?
Mhm.
I feel so terrible right now, like not knowing these things 2 weeks before the exam.
Accrual. But we were looking at this in unit one, unit.
Mm.
These are the
Mm.
basics. So, huh?
Mm.
So what is accruals? These are expenses or income recognized when incurred, not when cash is paid or received. These are accruals. For instance, salaries owed but not yet paid at the end of the year. They're called accruals. You've enjoyed the workmanship of your people. So it is an expense that you have enjoyed, but cash has not been paid or received. It's called an accrual. Consistency,
Mm.
this is using the same accounting method over time, applying it wherever over time. We call that consistency. All right. What is going concern?
Okay. So like an example on that one, on the consistency. What's the example?
Under consistency, applying the same depreciation. Remember, depreciation at cost or depreciation at
Oh,
what? At
okay.
you can choose that consistently. That's what you're using as a firm. So you need to
Oh,
give
I see.
an example in this case.
Okay.
So depreciation at cost. Going concern, you assume the business will continue operating for a foreseeable future. For instance, assets are recorded at cost, not at liquidation value. This is what a going concern. All right?
Okay. Mm.
Yes.
Yes,
Materiality
sir.
and business
Go on.
entity. Can you try on that one?
Materiality and business entity.
Mm-hmm.
Mm. Mm.
Materiality, it simply means you only consider material things, not immaterial. You can't open a pencil account. You can't open a pen account,
Mm.
okay? You can only record information that is significant to influence an economic decision. So small
I see.
expenses may not be separately disclosed. You can put them under miscellaneous or sundry
Mm.
expenses or operation expenses. That is a materiality concept. Business entity
Mm.
assumes that business must be treated as a separate entity from the owner. For instance, owner's expenses are not recorded in the business account. All right.
Okay.
Yeah. So I hope this has been helpful.
It is very
Yeah.
much.
Okay. So um we end here. So today's was an eye-opener that we need to understand the theory part of it. We can't go to ledgers before understanding these important concepts. Thank you so much for your time.